Recording. Let me minimize this. Anybody want to give it a chance? It's a little obscure. Okay. The movie is Reservoir Dogs from the Quentin Tarantino catalog, a classic. It doesn't age well. I I watched it with my kids, and I was like thinking like, oh, this was cool when I was in college. And then I was like, ooh, oh, this is not great. So, but it's from a different era, so you got to take that. Anyways, has some interesting dialogue, that's for sure. Welcome to the Market Watch Group. Working sessions. Tastes change, so do people. Markets stay the same. Trading psychology doesn't. That's why we do this. Yep, Sandy did get paid for that intro. Thank you, Sandy. You did it perfectly. Okay. Social and cognitive biases. That's what we're talking about today. Here's the disclaimers, as always. I'm not going to go through them when we don't do trading days. Here's the agenda. Let's put some names and some specific implications to some of the most common specific social and or cognitive biases that we are influenced by. I'm just kidding when I say overcomplicated. I really am not trying to do that at all. I think it's good to be able to just kind of be more specific and really be able to identify maybe then which ones you are more likely to succumb to, perhaps have a better understanding as to why, and most importantly, create a plan of action in order to prevent it ever happening going forward. That seems like a reasonable goal to me. How are we going to do that? Here is the agenda number one. Let's talk about them one at a time. Top 5. Overconfidence bias. Confidence is an interesting one because we can be just as adversely impacted by underconfidence. That's one that we really got to try to find balance with confidence. For me, and this is not in the slides, that's why I'm comfortable talking about this now. For me, confidence should not come from results. If that's the case, then you're not going to be as, in fact, I can't even remember if I put that in the slides. I'm like, gosh, I'm having an epiphany. Overconfidence, underconfidence, where is it rooted, your confidence? That's what we're going to talk about, even if it's not on the slide. Number 2, confirmation bias. Number 3, loss aversion. We did talk a little bit about loss aversion in my previous presentation. Myopic loss aversion, you'll remember the tendency to be more influenced than we maybe should be one trade at a time because we're so focused on each trade as an individual component rather than seeing sometimes the bigger picture. Anchoring is one that can really have an impact. Herd mentality, that's it. That's always one that I think has a significant amount of potential to influence traders in ways that they normally wouldn't. Very interesting. Herd mentality. So, just a little quick point of fact. Both of my children in the 6th grade participated in science fairs and were like high-level state champion. They made like state finalists with them. They won at the school and then the district and then the region and all the way to the state, which is, they were both not science kids. They both played sports mostly, but we put a lot into it. My son did a science project, and we built a maglev train, like a floating train using magnets, and you could like flick it back and forth. It wasn't really that good of a science project, but it was super cool because you could just like hit this train back and forth floating. My daughter did one on bullying, and that's where this herd mentality comes in. And people just from a young age, sixth grade, don't realize how much they're influenced by the herd. Fascinating, fascinating stuff. We actually took it from a college study and we replicated it at the sixth grade. And it's a study where you have these lines and you ask them which one's longer, and you have plants in the group, and they'll be like, it's this one for sure, like very confidently. Actually, I think it was the whole group. Maybe that's what it was. Maybe the whole group. Maybe what it was the. I think that's what it was. The whole group is planted, and then one kid comes in, and they all answer the obviously wrong answer, right? The obviously wrong answer. They're all like, yeah, it's A. And then you watch what the kid does. And there's some kids who are like, you guys are morons. It's this one. But way more just kind of are like, not sure what to do. And you can tell they struggle. And then they answer with the group. Herd mentality. It's amazing. This was, that's why I won. That one was like legitimately good science that was like replicating a study, but it was the same thing in college. It doesn't change as you become adults, right? Like, and you don't realize it. And it was interesting when you ask about their perceptions, right? Do you do this? No, I don't do it, but I see other people do it. And it's like, what? And yeah, they're just many adults. We keep doing it. So really, really fascinating. Game shows use that when you use a lifeline. There you go, right? Love it. So it's not like we're like, oh, this is deep science. This is the stuff that we deal with every day on a regular basis in way more ways than just in trading. These are social and cognitive biases. This is how they are um, projecting and in themselves into our trading, and then the impact that they're having. Right. That's why this is so important. It's not like, oh, what? Where did this come from? It's in so many different areas. We'll have an interactive discussion with some Q&A. Wrap it up. I'm excited for this. So let's go through these one at a time. Give me comments. Give me questions. Where is everybody? There's only four of us here for this amazing discussion. Those of you who are listening to the recording, you could have been here. You could have participated. You could have asked questions, right? That's 100% it, Sandy. We are essentially social beings and we want to belong. That's a very interesting. That's a very interesting observation. I love that. I've never really thought about like the bigger picture of beyond our own personal internal psychology of how we, I'm always thinking about, the more granular, right? The concept of heuristics, which are these rules of thumb that our brain develops because you're processing sights, sounds, smells, touch, emotions, and it's like all of this is happening in memories and thoughts and it's happening real time, constantly, millions of bits of information. The only way to process that is start to kind of create ways to do it quicker, quicker, right? And so sometimes it's good, sometimes it has to be reevaluated. But taking a step back and seeing that 30,000 foot view of just a person overall and the need to fit in, that's amazing. Love that. Okay, let me get a great quick drink. Overconfidence bias. Traders often overestimate their knowledge, skills, or control over events. When? Probably after a nice streak in the market, which could be when? Where are my charts? Let's get some charts. Move this over, make it bigger. Right here. This is an, nope, I didn't want that. Back up. Let's get the pencil out, and why is it not coming up? There it is. Huh. Give me 1 second. Let me close this and open it back up. So weird. Close window. Epic pen. Open. Okay. When right in here, everything's going great. I'm making so much money. I'm doing so great. And all of a sudden, right in here, they want to smash on a bunch of trades, right? And in there, we're saying, hey, things are kind of starting to deteriorate a little bit in here. And we're starting to ease up a little bit. It was very interesting when I used to teach those boot camps I tell you about, right? There'd be 3 or 4 instructors, and you know, like not to brag, but we were that was the spot. You got to go stay at these 4-star hotels in Park City, eat catered food. You teach live, and you would basically teach a third of it, and then you'd be in the room back of the room trading the other part. Um, the throwing good money into it. The It was interesting, right? We'd have great traders, people would come in, but inevitably we would ask, we would do a temperature check, like I do here. I mean, here it's different because we go through a full process, right? But we would just ask people, are you more bullish or bearish? And when everybody was like, there would be times when everyone was so bullish. They had, oh, I have more bullish trades on than I've ever had. And we would always be like, oh, this is like that last little like, ooh, everybody's in. There's no more room for getting in. There's gonna be a pause. And it always tends to come here. Right? Um, what did I do to get that? There we go. Okay. That was nice though to emphasize that because then all of a sudden you go from 8 to 10% risk to like, oh, I'm such a good trader. I'm going to do 20% risk, and in this period of time, you just took, all this time to grow your account 15%, and then right here you lost 20, and you're down 5%. You just drew down, you're negative, you're trying to, right? Like that's the kind of thing that you subject yourself to. Let me go back. So leads to excessive trading, underestimation of risk, potential losses. A trader making large, frequent trades based on a few. So you do good in the past. All of a sudden, you're doing a little better. What are your mitigation strategies? What do? We keep a trading journal. We review past trades objectively. We seek feedback. More than that, here's what I'll tell you. Your confidence should not be rooted in your results. You shouldn't look at your, well, I mean, you should be, I mean, your results are going to be like part of it. But just because you all of a sudden had a good streak doesn't mean you should start taking more risk. You should be confident that your results are based on your plan. Your confidence, therefore, is rooted in the underlying plan. We expect to do well because our plan will help us. When the market's good, we're going to make more money because we're going to push harder. When the market eases up, we're going to ease up. Like we're going to adjust as we need to adjust to be doing the right things for the right market conditions. I don't think that because I think I'm such a good trader. I think that because I think I am humble enough to recognize I better step aside from my opinion and really understand the market. That's what matters. It's the lawnmower. I'm a blade of grass. That's why I'm here. Because in times when the market gets nasty, I duck. And then when the market's shining and the lawnmower's going the other way, I stand up, get some sun, have a cocktail, right? Okay, so yeah, whenever you think about, and these are things that you should assess. How do we expose a bias? You put a light on it. Ask yourself, how is your confidence level and where is it coming from? What's the basis? What's holding up your confidence level. Makes it real quick and easy to find out and determine that, right? Okay. If no questions, I'm going to go on. Let me know if you do. Confirmation bias. That is a tendency to search for, interpret, and even remember information that confirms preconceptions, right? We um, have minds that work a lot like a search engine. As it starts to form an opinion, it's like you're programming it. So if I type in bullish indicators into a search engine, it's not going to pull up bearish things. It's going to pull up bullish things and only bullish things. Well, if I put too much of a message in my mind of bullishness, it's not going to see bearish things. Oh, you know what? I just thought of a great. Ooh, I got a good one. I have a good one for us later on around these lines. I'm not going to do it with only 3 of us. I'm going to try to get people to come back. But I've got a great video to show you, a couple of videos. Oh, I'm very excited about this. Yeah, this should be good. Okay. Back to where I was. Sorry, I got like distracted by my own thought. What do we then do? We ignore contradictory information. We don't see all of a sudden that we didn't make new highs, right? Which leads to poor decision making. What's an example of this? We only look for news that supports current position. You look at the news and you're like, oh, look, this is a good article. Doesn't matter. That doesn't matter. That's already been accounted for. You look back a week and you find something that you're like, look what happened here. It's still okay. How do we avoid that? Right? So when would confirmation bias occur? That's a question for you. Let's do some critical thinking. Where in our trading, at what point in our trading, do you think we would have a potential issue with confirmation bias? I can think of 2 really important ones right offhand that I'm looking for. And I want you to think back to stages of a trade. Sandy and Stephen, John, you weren't here for that. It's in our content library in the YouTube channel. You'll be able to find a Trading Foundations. So if you from the emails, if you click into the content library and you go into the Trading Foundation section, you'll see stages of a trade. And right, stage 1, pre-trade. Stage 2, waiting to develop when we first get in. Stage 3, momentum. Stage 4, nearing completion. Confirmation bias. Right off the bat, think about step 1. What has to happen in stage 1? I have to have a stop and a target, a time frame. I have to have a favorable reward to risk ratio. Right? If I have those things, it makes sense. Ooh, but somebody might bend the rules in there a little bit where they're like, oh, I'll take a 2-to-1 trade. Because why? Because they want to take the trade, right? All of a sudden, where things weren't good enough before, all of a sudden it is. That's where it's very important that the rules prevent confirmation bias on entry. Same thing with trade management, staying in a trade. You're getting signs that this thing's dying and you're like, maybe it's going to turn around. Look, there's good news. Follow the rules. If it doesn't move to stage 3 where you're getting a bullish Heikin-Ashi candle by a certain point in time, you've got to start thinking this thing is not going to get there. We don't just inevitably let it sit because we know that more often than not, if the buyers don't come, the sellers will. So we have to define it, right? Stage three, we hit momentum. Usually in stage three, we're okay because we should be tightening our stops. It's moving. Stage four, we have to really be careful again. Why stage four? Because sometimes we stop thinking about that getting close to the end part, right? We'll see 2, 3 really good days in a row, and we're like, oh, it's going forever. When we're like, wait a second, it's near what we had projected as our final target. If it gets to the final target, we're done. We don't think, no, let's go for more, right? Again, how do we stop this? How do we mitigate it? Seek out diverse perspectives. Regularly question not just assumptions, but also motivations. Why are you doing this? With stage three, there's a tendency to buy more. Okay, in a swing trade, yes, I agree with you. We can't do it. We can't do it. If you're in a trend trade and you're buying more, right? So Stephen, for you, some of your positions you'll buy and stay in longer and sell covered calls. I think if you hit momentum, you think, hey, let's throw a little more in because this thing's moving again, and the next time it stops, I'll sell covered calls. You might you might use that as an opportunity to, like, maybe you have 150 shares and you buy 50 more during the momentum stage, so when it gets to the next resistance, you can sell 2 contracts instead of just one. Um, but you're right. In a swing trade, we have to resist the temptation. You're either in it or you're too late. How do we prevent things like that? Your rules. Your rules must prevail, which means number one, you must have them, which means number two, you must follow them. If we don't have the discipline to adhere to the rules, and remember the root of the word discipline, disciple, you can't force yourself to do this. This is about believing that those rules are there for a reason. You believe in them and you're going to follow them even when you're not quite sure. You're going to say, look, I'm going to do it. If I need to change the rules because all of a sudden I find that there's a pattern of behavior or a pattern of results, more, not behavior, a pattern of results where you're like, wait a second, I'm following the rules and I just keep taking losses. Yeah. Eventually we got to stop. And that's where we might have a mechanism that says, hey, there's five losing, 4 losing trades in a row, or 5 of 7 losing trades, where you say, you know what, that's just a little outside. Yes, I recognize 5 of 7 is not a statistically relevant sample set of data that we're like, let's go make dramatic changes to what we're doing. That's not what we're talking about. We're saying that at that point, we want to stop and really dive into those 7 trades and be like, am I following the rules? Because if you're saying yes, then you're like, then those rules need to change. Then I need different rules. And that is going to happen to you. Yeah? Okay. Love it. Confirmation bias. We will revisit this. I will show you a video, and you'll find it interesting, I think. But just not today because there's just not enough of us, and I don't want to ruin the video. It's too impactful. And if you watch the recording and you see the video without, well, maybe we could. No, I think it's better not to. Okay, loss aversion. We talked about this already. The tendency to prefer avoiding losses rather than acquiring equivalent gains. And it's not just like, oh, you can either avoid loss or take a gain. That's not really what it is. We know that's rooted in more than that. If you took the psychology tests 2 days ago, not 2 days ago, 2 meetings ago, a week ago, then you know what I'm talking about, right? We really dove into the mindset of what we're thinking about in regard to taking losses and staying in winners, and how we need to shape that thought process. And the fact that inherently 80 to 85% of people are pre-wired to do it the wrong way, myself included. What then happens? We hold on to losing trades too long, take profits prematurely. We cut our winners short, and we let our losers run. And that is the exact opposite of the exact saying we know we're trying to accomplish. Cut your losses short, let your winners run. Well, it's minds. It's not that. It's mindset. So, what's an example of this? We talk about this as well. We refuse to sell a stock and hope it'll rebound. Oh, I hope. We're hoping with losses, and then what are we doing with gains? We're fearing. If I don't take my profits right now, the market's going to take it from me. I better hurry and sell it. And then we sell it, and then we watch it go up a little more, and then we watch it go. God, think about. Actually, Stephen, I'm gonna disagree. I actually have rules that include hope. I hope that my stock that's at 55 goes to 60. And when it gets to 60, I hope it goes to 65. I hope it goes higher. Let me ask you this. If it goes to 55 and you get out, do you hope it goes to 60? No. In fact, we almost hope it doesn't in order to validate the decision that we made. Yeah? Are those expectations rather than hope based on your rules? Well, the rules are in place in order to accomplish hope. Right? If you hope something goes up, why is that? Because you'll make more money if it does. Yes? I hope it goes higher. Now, what I will say to you is this. Hope can only be in your profit taking rules. How about that for a compromise? It absolutely belongs in winning discussions and stop. Yeah? If we're talking about winning trades, hope should be on the table, not on the table, at the table. Should be a part of the discussion. If we're talking about losses, there's no room for hope there. Right? What is the preference? An avoidance of fear. Should we have fear in our take profit discussions? I'm afraid of giving back gains. We can't fear risking. So look, Stephen, you're saying you are trading because you have an understanding of rules, to have an expectation. You plan for risk if it goes the other way. Yeah, right. You do. You do. You risk one to make two. And what do you wish? What do you hope for? You hope it gets the two. Yeah? Hope. On which side? Winning. Only on the winning side. Because if I hope it, the only reason I'm hoping is because I'm staying in the trade. Does that make sense? And look, you know what? Some people you may not see it that way. You might disagree. I believe that emotion absolutely plays a role. We're not trying. We're not trying to eliminate emotion from our trading. That's not what we're trying to do. I'm not trying to trade like a robot. I believe emotion will make you a better trader. In what way? Controlled. Controlled, right? Controlled fear. That's the fear that you feel when I'm jumping down a mountain on ropes. I'm not like, I have no fear. Controlled fear. It helps us to do what? To make sure that we check things. We don't get complacent when we have controlled fear. Uncontrolled fear leads to chimp actions. We react, we panic. Yeah? But nonetheless, it's controlled fear, right? And controlled hope. We don't just like, oh, I hope everything is fantastic. No, we hope it goes higher. And as it goes higher, we move stops. Hoping it goes higher means you're still in the trade. The second you take your, the second you close the trade, you no longer hope it's going higher. Now, that doesn't mean it's a bad thing, but it means should we still hope? Well, if I still can make two for everyone I have at risk, yes, I still hope it. And I will continue to still hope it. That's what the rule is to do. If I don't have a 2-to-1, I'm not going to hope it goes higher. With a 1-to-1, I hope it's going to all of a sudden get better. It's not. You're at the end. We already knew that. It's stage 4, right? It's stage 4 that we're talking about right now. So that's going to help us. Mitigation strategies, predefined stops, predefined targets, predefined initial take profits, predefined amounts. The more that we can establish before the trade so that we're just executing the plan, the better. Right? It's all about the rules, it's all about the plan. Okay, Stephen, here's the deal though, right? Your portfolio dropped a little bit. I'm not talking about a retracement. I'm talking about, are you taking losses because it was triggered by the rules? Now, if those trades still have an opportunity to make 2-to-1, 3-to-1, there still has to be a rule behind it. We cannot not take losses because we hope it comes back, right? So I agree with you. The fact that it dropped 7,000 is not what would be problematic. What would be problematic is if it dropped and you stayed in because your motivating emotion is hope. I hope it comes back. Now, if those trades all have favorable reward to risk ratios, then you're trading still with hope. I hope it recovers and achieves this favorable reward to risk ratio. That's more of a winning strategy, right? You're looking at that from a winning perspective. Does that make sense? I think it's a distinct difference, right? Do you disagree? Right? That's the basis, right? That's the basis of that Nobel Prize winning study. I think it's a distinct difference where we say, what is motivating me to stay in? And the objective being that we hope around our wins and we fear around our losses. That's it. And that is how we prevent cutting losses short, letting winners run. No, that is how we achieve cutting losses short, letting winners run, and prevent the other way around. Anchoring. Anchoring. Relying too heavily on a first, and not necessarily first, but possibly a more consequential event. So whether it's a first piece of information or a subsequent more consequential piece of information, something that has a more lasting impact in our memory, in our psyche. And then what? And then we want it again. Oh, right? We buy really expensive options right before an earnings announcement, and we catch a big like 12, 14% gap. And we're like, boom, easy 500% on that trade. Woo, easy money. Is that a good strategy? I made 500%. Boom, I smashed it. Is that a good trade? But Steven said, I have learned about buying expensive options, and I will quote a trader who said, I never learned anything making money. Okay, so what then happens? I made that money on that trade. Oh, I want that again, that 500%. So I do it. Boom, I lose everything. And I do it again. I lost everything again. What? I do it again. Boom. This time I only lost 50%. I do it again. Oh, I made 30%. Like, oh, I made a little bit. And I'm like, ooh, I was close. I was close. I sniffed. I still remember that 500%, right? And all we do is think about that 500, and all of a sudden you look at it and you've got 20. You've got 20. Keep rolling the dice. Blow on them and throw them, baby. Blow them and throw them. Okay, so then what? All of a sudden you've got 20 trades, and you've got that one big trade early on. Maybe it's not even the first one, right? Maybe you took two or three, and then you smashed it on the third or fourth trade. You knocked it out the park. Ooh wee! Look at that trade, 500%. And you want it. You need it. You keep taking the trade, and you're not thinking about those 19, especially if you're not doing what? Keeping records with real-time analytics that say, hey, buddy, you're 20 trades in, and you're right 21% of the time, right? And your losses are now bigger than your gains, and you're like, what? What? So yeah, we really got to make sure that no one trade has any more impact than any other. A trader sticking to a price target set early on despite new information, or a trader sticking to a strategy despite the fact that ongoing information is not supporting. All they can remember is that one time was amazing, and I can't wait to feel that again. Like we say, be water, my friends. Be water. How do we mitigate? Continuously updating information, flexible price targets. That's on a trade by trade basis. Record keeping. That's on a portfolio basis. We keep records. Record keepers do not become frogs in pot of waters. Pot of waters. Record keepers do not become frogs in pots of water that start boiling, because we're like, oh, shit, it's getting hot in here. And we jump, right? And we adapt. In this case, be like water means get out the water. Okay, herd mentality, last one. I'm loving this discussion. What are your thoughts about today, you guys? This is a lot of fun. Sandy said she is too. Thanks. She's enjoying it. Um, and yeah, okay. The herd mentality we discussed already, right? We're influenced, and we don't think we are, right? So part of that bullying, sixth grade bullying science fair project. What's funny is my son's actually got one level higher than my daughter's at the state level, and we were like, that is ridiculous. Like hers from a, but there was a reason from the judging why. Anyways, hers was like such better actual science where you're like, wow, this is like so enlightening into how the mind of like the playground on a middle school works. essentially we would ask them, oh, Sandy, oh my God, I'll have to see if I have the file of it and I'll send it to you because honestly, it was fascinating to watch these kids just like know the right answer and say the wrong one nonetheless at such a high rate. Then we asked them about their perception of bullying. Do you see it? They all said, yes, of course we see it. Do you do it? No, not me. Right? No, not me. I don't do it. Everybody sees it. Nobody participates in it. It's a very very interesting phenomenon, right? That we're like, and it's the same thing in trading. We're like, yeah, everybody's influenced by the herd. Not me. Are you sure? Following the actions of the larger group, often ignoring individual analysis, contributes to market bubbles and crashes. An interesting book for you to read. One of my more favorites because it's just kind of a narrative and you're just like, oh, that's interesting. It's called Extraordinary Popular Delusions and the Madness of Crowds. I do not know the author offhand. Extraordinary Popular Delusions and the Madness of Crowds. So it talks about historical bubbles. And I'm not talking like Beanie Babies, although put it on the list. I'm talking about uh, the tulip craze in the 1600s when options, right? Actual contracts that were covering the trade of tulips and that the price of one tulip, you don't even know if it's blooming for sure. One tulip had an inflationary adjusted price of like $10,000. Like that's what people in Europe are buying. He's like, he must have my tulips, right? They're like, what? Um, there is there is the South Sea Trading Company, not as famous, but it basically talks about this. Um, and here's the deal. I think it's going to continue happening. I don't think it's necessarily going to be the same, but I don't think we're anywhere near seeing what the cryptocurrency market is going to settle into. I believe it'll always exist. I believe that the strength and security of the blockchain model, as long as they can continue working towards more energy efficient solutions, it can process, it can store, but it's not really like an asset that's like, oh, Bitcoin's worth more because of scarcity. I mean, maybe I don't see it holding value that way long term. That's just my personal opinion. Um, Maybe I'm wrong. Certainly not whatever the number 4,000, 6,000, however many coins they come up with new ones every day. What could they possibly do from a utilitarian perspective that would justify uh, any ongoing increase in value? Anyway, I'm on a tangent. Back to back to what's at hand. I love Trading Places. That's on my movie. That's on my. It's a Christmas movie, in my opinion. Die Hard, Christmas movie. Trading Places, Christmas movie. Anyways, that's how it goes. I think it very much could be. It's going to take a little more time. There is big money in it that's trying to, keep it floating, but yeah, we'll see. Buying a stock because everyone else is without personal analysis. Um, Continuing to trade bullishly, despite the fact that that the VIX is escalating and the institutions are sowing discontent. That money flow is moving out of growth segments and into defensive segments. That we're seeing money shift from a growth mindset to a defensive mindset, right? These are the things that we analyze in our market posture. That's not like what's the herd doing. We're like, what empirically do we see happening in context with our analytical process in these 6 components? And how do we put it together to understand strength and or momentum? We don't follow herds. In fact, we say that whatever it is we think we see, we expect to see in the news 2 to 3 weeks later. Yeah, that's my thought, and I feel like we uphold that objective the vast majority of the time. Tell me if you disagree. Challenge me on that. Tell me if you feel like that the process you've put together has not helped you to see the market with significantly more clarity. And if you challenge me on it, then I'll do what I need to do to work to make it so we can. Mitigation strategies. We conduct not independent research, we conduct independent and group validated analytical processes every week. And then we align our personal trading strategies with this analytical process that hinges and focuses upon institutional money flow. Follow the money. Follow the money. Yeah, these 5 social and cognitive biases significantly impact traders on a regular basis. I believe that the processes we have in place should be mitigating and or eliminating them, but that doesn't mean it's happening. So you should be reflecting on these, right? We kind of had these. Any questions about any of these biases? Any instances we've been talking about them? Of course. What are the strategies to overcome these biases? Maintain a trading. I thought I'd change that. Trade log. Maintain record keeping. Record keeping means, right? Record keeping means you're logging your trades. It means you're keeping a journal. It means you're setting goals. That's what a record keeping process entails, right? You can't hear me? Give me a second. Test, test. Can you hear me now? Boom. Look at that. I learned quick little techniques. When it shuts down, I know how to reset it. So I love that you send that as soon as you do. Once I'm out and we have one person say it and a second confirm, we have a quorum, and that means I will fix it. So thank you both. Very efficient. Did it keep going out or just like it did today? I don't know. I mean, it's hard to have, like, it's not a big enough issue to like dig into it too much, right? Because it takes like 10 seconds to fix. I really don't know. It like sort of just like loses it, you know? Strategies to overcome biases. If I ever have time, I'll try to dive in a little bit more detail. It is low on the priority. Seek out diverse perspectives. Regularly question your assumptions. I mean, I feel like that's what we do, right? We challenge each other. I challenge that. No, I disagree. Yes, I see it. Nope, I see it a little stronger, a little less. We challenge each other openly. We're open to it. It's the only way to do it, right? I think. You record keep. You seek out diverse perspectives and regularly question your own assumptions. Period. If you're not doing those 2 things, you are not going to overcome these biases. You are going to suffer from them in a cycle over and over and over. I've seen it. These are the 2 most important strategies to help overcome them, right? Record keeping and seeking out diverse perspectives with regularly questioning assumptions. Okay, let's wrap it up. Overconfidence bias leads to excessive trading. Can't do it. Question and assess your own confidence level. And where is it coming from? Where are you deriving your confidence? Confirmation bias, ignoring contradictory information leading to poor decision making. We know that we build our rules in a way to emphasize our ability to let our winners run and cut our losses short. Loss aversion, same thing, both of those two, right? Anchoring bias, we know that our record keeping is what really helps us to see things with clarity. Herd mentality, same thing. That's interesting. I didn't even think about that. But yeah, anchoring bias, herd mentality definitely is something that we can account for through our record keeping process. Overconfidence confirmation, definitely through rules, right? So rules and record keeping, and a desire to search out not just validation but also um, opposition, right? I welcome it. Challenge, challenge it. All of us, we should be challenging each other. So there it is. What an amazing discussion today. I have actually never really done a psych presentation. Like that last presentation was like 15 years old, maybe even more, maybe even 18 years old. Close to 20 when I come to think of it, actually. 19 or 20 years old. This presentation, building off of that, is a week old. That's what I mean when I say it doesn't change. Stuff doesn't change. We're always going to be subject to these until we break the cycle by what? Shining a light on it. Shine a light on it and say, are you doing this? How will I know? Well, look at what we talked about is what leads to it. So awesome discussion. I'm gonna give you 1 minute back. Look at that. We wrapped up a minute early. I'm just kidding. We're right on time. Tomorrow, um, tomorrow, I need to. You know what? I'm glad you're here, Sandy. I'm gonna send an email out. I need to change. I'm gonna change the time of our meeting tomorrow. I need to change the time. Sandy, what time is our tomorrow meeting for you? Just so I have a sense of that. We're gonna have to meet kind of middle of the day, middle of the market. Ooh, that's not good. 5 a.m. I'm glad I'm telling you this then. It's going to have to go a little earlier. So I'm going to say we may not see you, and I apologize for that, but I will make sure it's recorded. When you wake up, whenever you wake up, the video will be waiting for you in Discord. Is that fair? You can make it. I'm thinking then, give me 1 second. I'm going to look at my schedule. I had an unexpected doctor's appointment, and Glenn was not able to. I need to go through the market ones with him a little more before tomorrow. The schedule. 2 hours early. Are you sure? It's gonna be 3 a.m. 2 hours early. I'm gonna change it while we speak. I'm gonna edit. Tomorrow the weekly market wrap, so it'll show up on your calendar that way. I'm gonna edit it to a little earlier. Save. Okay, so it's now saved. So if you go check, Sandy, it should now say 3 a.m. Do you want to check and just verify for me and let me know? And then, okay. Stephen, John, 1:15 p.m. Eastern time instead of 3:15. So we're going to go middle of the day instead of end of the day. I hope you can make it. I'm going to put a message. I'm going to put an alert. I'm going to message. I'm going to email. But since you guys were here, you know the drill. I know there's going to be a few people who missed because of that, and I'll have to apologize. But I'll give as much notice as I can. It was just a late afternoon thing that I had to get scheduled. So, okay, awesome. You guys are amazing. I appreciate that you came, that you took your time to hang out. And I just want you to know I had a great meeting with like my, powers that be partners with this project, this group of ours, and we're really pushing to get another few things in place to expand the community. We've really wanted to be careful about making sure that we built this the right way, and we feel like we're very close, so we can now move into a little bit more scalability. So, anyways, and you guys, you pioneers of the group, you have been instrumental in making that possible and contributing and shaping this to what it is. I love what it's becoming. So I appreciate that. Have a wonderful night, you guys. And that goes to you, all of you listening to the recording, because I know some of you all will catch the recording. The same thing. That thank you goes to you. We're really turning this into something meaningful that gives you a safe space to learn, to practice, to move the ball forward at a much faster rate, I promise, than you would via any other mechanism. Thanks, guys. Have a wonderful night. As always, happy trading.